Imagine a world where the banks could actually pay you money for the privilege of lending you money. It sounds crazy, right? If the RBA cuts interest rates to below zero, it could happen, and actually has happened in other countries. In Denmark, borrowers at JC Bank were able to take out a 10-year loan at a rate of negative 0.5%. So, if you had $100,000, the bank would pay you $500 every year, even if you didn't make your repayments. But will it happen in Australia? RBA Governor Philip Lowe has previously insisted the cash rate will be maintained at its current record low of 0.1% for as long as necessary, until rates are forecast to rise in 2024. But the Australian Prudential Regulator, or APRA for short, has just issued a new letter to the banks saying that they should be prepared for a scenario where the cash rate may fall to zero or below. And while economists are predicting that the RBA might raise rates faster than they're telling us, APRA is asking the banks to be prepared for zero or negative interest rates. So what gives? In this video, we're going to take a look at the effect that negative interest rates could have on the property market and our economy. We're going to cover how they work, what causes them, and what it means for you. Now, before we jump in today, hit that subscribe button and give us a big like, and leave a comment below. I read every one and will look to reply individually myself. So let's dive right in. How do negative interest rates work? Let's start off with the basics. Interest rates are often defined as a price paid to borrow money. For example, an annualized interest rate on a $100,000 home loan means you'd pay the lender $2,000 per year in interest. When the interest rate is negative, it's the opposite way around. So if you took a loan with a negative 2% interest rate on a $100,000 loan, the lender would actually pay you $2,000 to borrow their money. So what causes negative interest rates? Negative interest rates are traditionally introduced to help revive a slow economy and prevent something called deflationary spiral. What is a deflationary spiral, you ask? In harsh economic times, people and businesses tend to hold onto their cash while they wait for the economy to improve. But it causes further damage to the economy. A lack in spending causes further job losses, lowers profits, and causes prices to drop. It reinforces people's fears and makes them even more likely to hoard, which slows down spending even further, causing further job losses, lower profits, and lower prices. Negative interest rates make saving and hoarding money less attractive because it actually costs you money to keep your money in a bank. So the theory is a negative interest rate incentivizes spending and incentivizes the bank to loan out more money. Now, has this been done before? We've never had negative interest rates in Australia, but if we did, we wouldn't be the first country to do so. Sweden's central bank was the first institution with this policy. It cut its overnight deposit rate to negative 0.25% in July 2019. They've since increased their rate to 0%, but at the moment, Switzerland, Denmark, and Japan all have negative interest rates. A further 22 countries in Europe have an official cash rate of zero. What would negative interest rates mean for my mortgage? Well, if you're on a fixed rate mortgage, nothing. You're locked into a fixed rate for the duration of the fixed term, so nothing would change. If it's a variable mortgage, the rate could fall a little, but the drop is likely to be limited by the terms and conditions on your mortgage. You would need to speak with your lender or take a look at your terms and conditions to see what effect a negative interest rate would have on your loan. Could new mortgages be free? It's unlikely, but it could happen. As mentioned earlier, last year, a Danish bank offered a 10-year loan with a rate of negative 0.5. This year, another bank in Denmark started offering a 20-year loan with a 0% interest rate. What happens to my savings? It's theoretically possible that the banks could start charging you for the money you hold in your bank account if interest rates go negative. But it doesn't mean you should withdraw your life savings and hide it under your mattress or bury it in the backyard. Instead, you might want to consider investing in other high-yielding investments such as corporate bonds, shares, or even property. Which brings us to our next point. What would this do to the property market? It's hard to say. As mentioned in our last video, low interest rates are the biggest driver to increase property prices. If people can afford to borrow more money, they'll spend more on a property. We've never had negative interest rates happen in Australia, but we can look at Denmark as a bit of a guide. Now, Denmark adopted a negative interest rate policy. This in turn triggered a property boom. The Denmark House Price Index, which measures residential property prices, has gone up 80% since then, averaging a 9% year-on-year increase. In comparison, Australia's quarterly price index has fluctuated between -3% and 6%. As we've seen in the past 12 months, the current low interest rates have lit a fire on the Australian property market with massive growth. So if interest rates go negative, we'd expect this would only pour more fuel on the flames. Owner-occupiers will find it easier than ever to get a home loan. There's only one thing that might slow it down. Negative interest rates usually reduce consumer confidence. So people are more likely to hoard money in case the economy goes further south. Is it going to happen? It's pretty unlikely. We're already in a housing crisis thanks to the low interest rates. The RBA would need a very good reason to take rates into a zero or negative territory. And as mentioned earlier, the RBA is on record saying that a negative cash rate is highly extraordinarily unlikely. There are significant risks and costs involved with going into negative cash rate. So it would only be a last-ditch effort to save the economy. Still, APRA considers it possible enough that it wants the banks to be prepared for the situation if it does occur. APRA said there are risks if banks are not prepared for zero and negative interest rates, and they are material enough to trigger its prudential standard CPS 220 on its risk management. So in other words, I wouldn't hold my breath. Now you might be thinking what you should do. Honestly, there's not much you can do. It's very unlikely that we're going to see negative interest rates in Australia anytime soon, ever. And if it does happen, then it really depends on which side of the fence you're sitting. If you've already got a home loan and rates go into the negative, then you can look forward to even cheaper money than you're already paying. If you haven't got a home loan at the time, then the biggest issue is that it'll make saving a deposit that much more difficult. So if you've already got a loan, don't worry. There's only upside if it does happen. If you don't have a loan and you're saving for a deposit, my advice is save like mad and get into the market as soon as you're ready. So that's it for today, guys. Thanks for watching. If you have any questions, hit us up in the comments below and we'll see you next time.